The broadcast is now starting. All attendees are in listen-only mode.
Hi there, and welcome to our Business Credit Consult team Thinking Like a Lender webinar series. We're excited that you joined us today, and we're excited to jump into our topic in our Thinking Like a Lender series, which is personal credit reports. Now, you may be asking, why are we talking about personal credit reports when our main focus is building business credit and establishing the business credit reports? The reason that we're talking about personal credit today is because, like it or not, there are certain types of financing that will require a personal guarantee. So we want to be clear about that, identify how the personal credit comes into play, and then what we can do to avoid using personal credit whenever possible. So what we will do is dive right in, and then as you have questions, feel free to submit those. We'll go over them at the end. Additionally, these are always posted on the Business Finance Suite YouTube channel. You can subscribe to that channel, so anytime we add a video, you are notified via email. Well, let's dive right in. I've got a copy of a sample personal credit report here. And like we talked about, every once in a while, a personal guarantee is required. What are those situations? When you're a business owner, everybody seems to ask for the personal guarantee. Why do they? Let's dive into those questions. So the reason as a business owner you're asked to furnish a personal guarantee is because personal credit is a very well-established reporting system where lenders feel comfortable reviewing the information, and they have found that the business owner often handles their personal credit the way they handle their business credit. Okay, now we really strongly urge our customers to separate their personal credit from their business credit. How is this possible? As you establish your business credit, there are certain type of financing options out there where you don't need to add a personal guarantee. For instance, Amazon.com or Staples, Best Buy, Apple, all of these type of vendor accounts offer a business credit account without a personal guarantee. Now, there are some that will typically require a personal guarantee where the established business credit doesn't do enough for the lender for them to remove the personal guarantee requirement. That said, you can still keep your personal credit and business credit separate to a point, which is if you're giving a personal guarantee for business financing, you want to make sure they're not going to report that business credit on your personal credit report as debt, keeping it as separate as possible so that it's not hurting your personal financial situation, which, if we're honest about it, that could also impact your business. If there is financing that requires the personal guarantee and you need that financing, if you have a whole bunch of business debt reporting on the personal, that's going to hurt your credit. I would say that is the number one mistake that business owners make. And I have been working with the business credit program for over 10 years, tens of thousands of customers, and that is what I'm picking as my number one mistake. What happens? Well, let me paint this picture for you. For instance, we have our example here, John Q. customer. He needs financing for his business. You know what type of financing he knows better than any other? He knows it's easy to get. He can get it right away. He gets these little applications mailed to him all the time. You got it right. A personal credit card. So he fills out the credit card even though it's for business financing to finance his business. He fills out the personal credit card application. He sends that in and uses his personal credit to finance the business. Well, what happens when that credit card gets maxed out? all that business debt is sitting on his personal credit report. His personal income has to offset that debt that has been placed on his personal credit report. We call that ratio their debt to income ratio. So there's a lot of issues with A, you have a maxed out credit card that drops your score. B, your debt to income ratio is hurt. C, you created an inquiry on your personal credit report. There's a lot of issues with going about financing your business that way. Number one, error. And it really has a huge impact. So now that he's maxed out that card, you know what? He is going to have a hard time getting approvals for any other type of financing, both personally and on the business. Yes, he pays his bills on time, but that card is maxed out. He has a recent inquiry. That makes lenders nervous. It hurts his how easily he will qualify for financing, and it's not worth that risk. Best case scenario, if we were to turn that around and say he did not make the number one mistake, he would have applied for a business credit card, of which he knows does not report to the personal credit bureaus. Now, how would he know? That's a bit tricky. Partially, that's why you're in the program here with us, is we can define that for you. We have contacts with lenders that can help with that, but you have to choose a business credit card that does not show the balances on the personal credit report. Don't be fooled. Just because it's a business credit card doesn't mean the debt's not going to show on your personal credit. There are plenty of credit card companies, big mainstream credit card companies, that are now reporting the business credit card debt on the personal credit report. But there are plenty of options that don't. It limits you a bit, but it's a protection for you, and you can see why that's so important. So if he went about this best case scenario, he would have gone for the business credit card or the business line of credit, which really has about the same underwriting process and the same approval amounts, just with less headache on the credit card, and he could have got that financing he needs. So there's a little background as to when personal credit is used, why it is used, why lenders like it. It's a refined system. It's regulated. It's been around for a long time. They have algorithms already set up because the lender probably does personal credit lending too. They just like a personal guarantee. A personal guarantee does mean if the financing goes south, you are personally liable. So use it wisely. Try and maximize your use of those trade accounts and other types of financing that don't require the personal guarantee first, and then you use these others like the line of credit, the credit card, and some types of bank loans will typically always require that PG. Okay, so now we know why personal credit is used, and I couldn't go through this webinar without explaining the intricacies there as background. We have that foundation. Now let's look at the credit report like we're a lender. I was a business lender, and so I'm going to give you my perspective, and though it may not align with the way we think as consumers, this is very much the way that a business lender looks at the report. The first thing they do is prevent against fraud. Fraud is a huge issue. It's not on the forefront of our minds, right? We're not submitting fraudulent applications, but it is at the forefront of the lender's mind, preventing fraud. They get a lot of fraudulent applications, and a lot of people will try and wiggle their way out of being liable for debt. They have to have all their ducks in a row. So what they will do is look at any public records, any information they can find on that individual. They want to verify that and make sure it checks out with the information they find on their application. Let's say the name is spelled different on the application than it is on the personal credit report. That's a huge red flag. The address is different. Another red flag. These are things that they're concerned about. So one, they're preventing against fraud. After that, they're going to look at the actual credit. Now, what are they looking at when they look at credit? They're going to look at who the lenders are. They're going to look at any notes, status, and the type of financing. So they look at the date it was open. How old is this debt? Is it fairly new? If it's really new, then I'm concerned as a lender because I really haven't seen how this customer is handling this new debt. It could put them under. Why are they then coming to me for financing if they just got financing? Does that mean they need financing to pay for the financing? You can see it's almost a cynical thought process, right? Their underwriting process. So have I seen the effects of this new debt? And, are they past due already? This is, not brand new. And so the lender would probably feel pretty comfortable that they're getting a good history here. It's an installment, meaning it's a loan where they have typically fixed payments. Here's the term. Here's the original credit amount, the high balance, and the recent balance as of this date. So it's showing me that it was paid off. On the financially, they may want to take a little more risk, that type of thing. So it's a moving target. And not only that, it's not a black and white target. They're putting everything into the bucket to see what color it turns out to be. Okay, accounts in good standing. You can see that this is an older account. I like that. It just shows me they've had credit for a long time. They're experienced. It's not a brand new thing to them. I have a good amount of history to dig my fingers into and see how well they're doing. This is an installment. Again, that's a loan. The term is 65 months, so it looks like an automobile finance deal, and sure enough, it is. It's currently open. This is the credit limit, the original amount. This is the recent balance as of that date. So you can see that's what I'm looking at as the owner and as the lender, and I'm just checking that box off. They have an auto loan and they've handled it for a good amount of time. Here's another item. It's a revolving item. I like that it's revolving, but it is closed. And the credit limit or the current amount is not applicable. It's paid off. Here is the high balance. And then we can go and we see the inquiries. And like I said, this is an example report, so it's not extensive, but let's talk about revolving debt. Let's say that this high balance of $10,000 was also the recent balance, and that's the original amount. When I see that it's maxed out, that's a concern. I suggest, and everybody has a different opinion. And like I said before, underwriting is not black and white. Everybody has their own underwriting standards. They have their own scoring systems. Banks have their own scoring systems. But I typically advise business owners at the most 50% on your revolving credit, on your personal credit report. It doesn't matter as much on your business credit report, that revolving percentage, but on the personal credit, it's a large factor. If you want to increase your score quickly, that seems to be something that you can do to get high increases quickly. Lenders do not like to see those maxed out, and that's per card. I will get customers that come to me and say, I'm at 50%, and then I look deeper and one card's maxed out, the other one's paid off. That doesn't count as 50%. What counts as 50% is each card at right around that 50% or lower. It's not a combined balance. Then we go to the inquiries. And like I said today, we're looking at this from a lender's eyes. I'm not talking so much about what you can do to improve your personal credit or if there's negative items. It's really looking at this from a lender's eyes. The next area is inquiries. Why do I care about inquiries as a lender? The reason I care is because each inquiry represents an application for financing, something that gives this individual the chance for more exposure. So if I can see they have 10 recent inquiries within the last 5 days, they are shopping for financing and I'm the 10th stop. What that tells me is they got declined along the way. I don't know if they're declined. All I see is the inquiries, but I'm running that risk that they were declined everywhere, so they came to me. Why were they declined? And you know what? I'm not willing to take that risk as a lender. That's why inquiries matter, is because what if this inquiry happened 5 days ago and they got financing from all of those places, yet the credit is not yet showing on the personal credit report? Again, I'm not willing to take that risk as a lender. I'm going to wait for those inquiries to season so I can see if any new debt is going to pop up. That is why inquiries are an issue. And every lender, as we just talked about on the revolving, has a different threshold of which they say, you know what, that is just too many inquiries. I'm not willing to chance it, right? And usually we say a 6 to 12 month time frame. Personally, I recommend that people keep it under 6 in the past 6 months. 5 to 6. If there is 5 to 6, you likely won't get approved for business credit with a personal guarantee at that level. Even if you were house shopping or car shopping, that does affect your chances for a business credit card because of what we talked about. They know that some other debt is pending, possibly. Or what were they shopping for? Do I really know it's car shopping just because it was Ford Motor Credit and then a couple local credit unions? I don't know for sure what they were shopping for. Okay, and you know, underwriting is automated. Small business financing, don't let that phrase offend you. Small business is anybody that makes right around under 10 million in gross sales per year. So it really includes a majority of small business owners out there. Small business financing is typically automated. They throw this in a computer and the system tells them whether to approve or decline. It's not really the lender's choice. They just convey that message. They take the application, they convey the message to you, the customer. They have a general idea of what the requirements are, but legally they just are supposed to give you the generic decline reasons that they're regulated to give. Unable to verify business, inquiries too high, high revolving. You may not even know which card, nor is the lender supposed to tell you. These are things that you need to know how to do, to log in to your personal credit, read the report, and understand what their buttons are, and really decipher or decode what those decline reasons are. Even better to just know up front that these are the sensitive items and go in with your best foot forward, the best chance for an approval. A majority, and I've said this before on webinars, a majority of applications I decline could have been prevented quite easily by just submitting the correct information, making sure the business name, address, phone number, all matched on all of their public records, their entity, the 411 listing, the business license, making sure the name and information on the personal credit report match the name and information on the application for the business financing. Those things would have helped those business owners get approved. The other, like I said, the number one financing mistake that business owners make is getting that personal credit card, having the business debt on the personal credit report as actual debt. I would say that's the other reason that they are declined that could have been prevented. It's a little harder to fix than just having inaccurate information. But once again, it's all about being proactive, getting the information you need to make these decisions and to make them well. This learning curve is large, and that is why we're here. We try and make this simple so that you don't have to make those common mistakes. We don't beat around the bush. We get right to it and tell you how these lenders are reacting in real time. Because we work with so many customers and lenders, we get that feedback regularly. So that is what I wanted to dive into on the webinar today. I'm going to review and see if I have any questions. I've got none. So I must have gone into a lot of detail there. If anybody does have questions, please feel free to submit those. And of course, you can contact us with your questions. We are always here to help. What makes me happy each day is really helping business owners. I've talked with so many. It's a lot of fun. I've worked with aerospace to pet supplies to you name it. And it is a lot of fun. I have learned a lot about the businesses that are out there, and it's a fun journey because entrepreneurs are exciting. They put all their heart and soul into what they are doing, and I respect that. So I'm always here to answer questions. To wrap this up, I want to just, briefly review what we talked about. Personal guarantees are used from time to time by lenders, and they use these because that's their comfort zone. You can build business credit, and you can get those trade accounts. You can get Amazon and Apple. You can be creative on how you utilize that financing so that you have enough funds on the business side where you may not need a large loan or a line of credit. So that's one of your first defenses against a personal guarantee. If you build your business credit far enough, there are a couple lenders out there that'll give you a credit card without a personal guarantee that you can use anywhere. That's a great option too. Now, there's revenue financing that doesn't necessarily require a personal guarantee. They're secured for equipment that may not require a personal guarantee. Beyond that, the lines of credit, the credit cards, those type of facilities typically require a PG. And you just need to make sure you do it right. Make sure your credit's ready. Don't make those mistakes where you have all that personal or all the business debt on the personal credit report, and then it's too late to get the approval when you really need it. It's important to be proactive and put that best step forward. And that's why it's important to understand these principles. I'm going to wrap up this webinar. Thank you so much for joining us today. I'm going to look one more time, see if we've got any questions. We don't. Well, thank you for joining us. As you know, this webinar takes place every Thursday at 3:30 p.m. Eastern Standard Time. We will go over many different topics, but right now we're working on our Thinking Like a Lender series. Join us next week. We'll have another topic on the Thinking Like a Lender series, and we're just thankful you joined us today. You can check out this webinar again on our YouTube channel. Have a wonderful day.